we've got kind of a lot to discuss in terms of this whole idea of the recession fears, and you kind of mentioned this before about how the landing, soft landing, hard landing, no landing, um, the idea behind the landing gear being what's most important. And to you, is that landing gear really productivity? And uh, is that something we get from robotics, of course?
Yeah, I think without doubt that if we want to see better productivity, the only way that comes through is with improved automation. And so when you look at the expected benefits from improved productivity, they're really meaningful. And McKinsey
Mhm.
just recently did a study where they talked about U.S. being able to add $10 trillion to our economic output by 2030. Seems like a big number, and that's in the
10
context
trillion,
of
that's with a T, right?
right 10 trillion. It
Yeah.
sounds like a big number, but if you sort of peel the onion, it really isn't. But it is a meaningful number. Okay, so the
Mhm.
U.S. economy is roughly $25 trillion economy. So over the next 8 years, that's going to add roughly about again $10 trillion improvement with just a 2% improvement in productivity. Um, so that's what the numbers are. The U.S. or the world global economy is roughly 85 trillion. So that's over $500 trillion in size by 2030, and just improving that by 2%, gets you a pretty big number, right?
Mhm.
And so, if you look at what happened in during COVID, the improvement was all 100% the result of productivity. And
Mhm.
we went into the pandemic and we exit the pandemic 1% higher GDP. We did it with 6.5 million less workers. That is the definition of productivity, all as a result of robotics, automation, and AI. And so I have high hopes and beliefs that that's exactly what's going to occur as we go forward. And I just continue to emphasize to our investors and to all investors is the importance of staying invested and staying the course in robotics, automation, and healthcare innovation. And the investors who have followed that guidance have already benefited from the recent reset that's already delivered plenty of green shoots. And I think that we're going to continue to see this. And not long ago, automation was considered a luxury for companies, looking to increase productivity and lower costs, improve margins, and sort of outplay the other tech savvy competitors,
Mhm.
or less productive competitors. But today, as the cost of robots and other automation solutions is becoming increasingly affordable, automation shift from nice to have to a necessity.
Mhm.
And with automation now a priority in nearly every sector, many of our companies are entering 2023 with record backlogs. So we got companies like Fanuc and Yaskawa and Rockwell and Daifuku, which does picking and sorting equipment, and another company, AutoStore, that's a Oslo-based company that has robotic warehouse technology. Palo Alto Networks, um,
Mhm.
crowdsource, ASML that produces the semi-cap equipment, manufacturing equipment, Stryker. I mean, I can go on and on. All have record backlogs,
Mhm.
and I think this is important because the market is fixated on the macro, every day, and wondering which way is up or down, and they're not really paying attention to what's going on. And our indices, I think, are kind of leading the charge forward.
Mhm.
So, what are some of the maybe some of the next areas where robotics is going to maybe become more mainstream? Are there any kind of immediate kind of fields where that's kind of the next thing? Like right now is like warehousing, manufacturing. It's had a big impact. Other
Yeah, I think
new
that's
areas?
one area that we're really excited about. I think, generally speaking, that the digitalization of the economy is obviously proceeding at a pretty brisk pace, and business leaders all over the world are now taking full advantage of an increasing set of broad automation technologies out there, right? So everything from software to cloud to advancements in robotics and machine learning.
Yeah.
And these trends are providing investment opportunities related, to a few themes. And one of the themes that we love, is warehouse and logistics automation. And
Hmm.
generally speaking, autonomous systems are really beginning to take off. And the evolution of how humans move from sort of point A to point B is fascinating. Okay, it took centuries to go from traveling on foot and horseback um, to more efficient modes of transportation, right?
Yep.
Horse and carriage, then to massive ships crossing the sea, and then you've got rapid succession came with the trains and the automobiles and airplanes, which obviously
Yeah.
increased human mobility. Now we've got another big inflection point, and this is thanks to autonomous systems, which are enabled by connected electric and smart technologies. And smart robotics and AI and automation are revolutionizing the supply chain, and they're allowing for better integration and more efficiencies at all stages of fulfillment. In the US alone, there are roughly 20,000 warehouse and logistics facilities, and I believe roughly 5% would be considered heavily automated or
Mm.
highly automated or even somewhat automated. So that means that 95% of other areas are not, enabled.
Wow.
And I think when you've got the speed and the flexibility and mobility of today's robots that prove that the technology is more dexterous than ever, and you've got, a lot of other applications that are really evolving because of advancements in deep learning, and you've got radar, lidar, and vision technologies
Yeah.
and sensors that can classify objects and sort them and use perception for better planning and route planning. I mean, we're seeing just a massive evolution here. Warehouse and logistics automation is roughly about 12% of our robo index, and it's actually one of our best performing subsectors since we launched almost 10 years ago. It's up in the neighborhood of 350%. And we're just scratching the surface on where things are going.
Hmm. So it seems like what you're saying here is, we're still in early days here. The widespread adoption hasn't happened, and even some of those names that you mentioned, as you mentioned earlier, the overlap with the S&P 500 and the Nasdaq really isn't there. Some of those names are probably names that people haven't heard of before. So how do you kind of identify these potential winners? Do you kind of cast a wide net to kind of get all of them, and let the market decide who the winner is, or do you kind of drill down a little bit deeper and say, hey, this one is better because of, and what is that X factor, I guess?
Yeah, no, we don't cast a wide net. I mean,
Hmm.
we're not sort of trying to populate this with just throw paint against the wall and hope it sticks. I mean, we're really trying to focus on identifying companies that have high revenue purity. Okay.
Hmm.
And to get into our index, that has to fit in one of our subsectors that we've defined. So that's the first thing. And then we're looking for the high revenue purity. And again, as we sort of initially talked about, we're trying to identify the companies that have dominant market share. I mean, we want to find the best of breed pure play companies. So we're looking for companies if they're not sort of number one, two, or three in share. Number three, not because they've moved down from one to three, and maybe migrating even lower. I mean, we're looking for companies that have staying power. We're looking at the companies that have commercialization, that have technology leadership. We spent a lot of time trying to understand their technology and the moats around that business. And then we're spending a lot of time understanding how and where they're investing. We look at their R&D and D and where they're investing. We look at their acquisition activity, their success, their historical track records, et cetera. So we spend a lot of time looking at that. We then cast a ESG filter around that,
Hmm.
and out pops an index, and then that is a very active approach to how we look at things. We balance it monthly. We trim the stocks that have rallied. We've bought into the stocks that have sold off, and we're constantly rebalancing. And we can own no more than well. After that's done, that's sort of the active approach. The passive approach would be we put it in an ETF wrapper, and then we have sort of passive filters. We look at A company has to be exchange trade eligible. It can trade no more than we can own no more than 5% of free float. It has to have a certain market cap and liquidity for us to be able to own it. And so
Mhm.
we review this, quarterly. Our portfolio, we're reviewing it not just quarterly. We look at companies really on a daily basis. We have conversations and meetings with management teams. We meet them at conferences. We meet them in their offices. I mean, we meet with the competitors, etc. So we're constantly staying on top of them.
So
Mhm.
really really the key is find the leaders in these huge growth areas and concentrating on in on them to really kind of get the bang for the buck with there, right?
True, but we have what we call sort of a modified equal weight. Essentially, we have a more or less a 2 or 1% position in companies. So we're not really taking an overweighted, concentrated bet like some of our other competitors, have done. And we've done that very conscientiously because we know investors want to get from point A to point B with the least turbulent aerospace as
Yeah.
possible.
Yeah.
Uh,
Mhm.
Concentration, brings a lot of risk, and investors love it when it works, but when it doesn't work, they don't like
Yeah.
it. And we've designed this index not to pick the obvious winner. We think a lot of our companies, will be winners, and they are. They have been winners. Our returns speak for themselves. We're also fortunate that a lot of our companies are in the catbird seat to be acquired. I mean, because
Wow.
we
Wow.
don't just focus on big, massive, liquid names or big market cap only. We invest across market cap spectrum. It's roughly about 40% would be large cap. Or, I'm sorry, 40% is 45% US and the balance internationally. And we're probably again, more or less, I would say 30 to 40% large cap and 60-ish%, small and mid cap. The median market cap for Robo is about 6 billion, and
Mm.
because we've capture a lot of exposure in small mid cap, we get a lot of impact from M&A benefit. Since we
Mhm.
launched Robo, we've had almost a third of our companies have been acquired or
Oh,
attempted to be
cool.
acquired. That's a
Wow.
portfolio of around 75 names.
That's
Oh, wow.
awesome.
Yeah.
Yeah.
Mhm. Um, so, before we end this segment, I want to just kind of circle back a little bit because you mentioned, of course, Chat GPT is something that is kind of the new shiny thing, and uh, big adoption rate. A lot of people were very intrigued by it, wanted to try it out, wanted to kind of see what it's all about. Where does it kind of go from here? Is it still kind of too early to tell? Is this something that's investable right now, or do you just kind of have to wait for something this new to kind of get those use cases out there and get some of the wiggles out, I guess, in these early days?
Well, artificial intelligence is the big news right now, obviously, thanks to a wave of federal applications such as, Chat GPT. And this tool and many others sort of demonstrate the quantum leap that's taken place over the last few years and what AI is capable of. And this wave of innovation is, a process of hitting the world of business and redefine what's possible. I do not think that this is a fad. I think that the opportunity here, it's really in terms of igniting a deflationary tsunami, is very, very probable. As it has the ability to transcend pretty much every industry by optimizing growth and lowering costs. I mean, think about it. When was the last time that we saw a piece of technology that was so versatile that could solve problems and surprise people in so many ways? I mean, you've got
Yeah.
the ability to write a poem, a text, fill out a spreadsheet. You can write Python, code or do a structured, query language. So this is all the power that's coming to the consumer. I mean, think about what Google has enabled us to do in search. I mean, the average person probably does 7 or 8 searches a day. But imagine do 7 or 8 searches 20, 30 years ago. I mean, you had to go to the
Mm.
library and
Yeah,
look
it's
in
true.
books and do a search on something. But
Card catalog.
Yeah, it would take all
how
day.
how much does the average whale weigh? I mean, we can ask Siri and they can tell you in less than 1 second. If you had to go to the library to do that, it might take you 30 minutes.
Right.
Mhm.
So I think we're scratching the surface of where this is going to go.
Mhm. Now, one thing I just want to address real quick, again, because this is still early days, and one of the issues that has come up with this technology is um, accuracy. So it's using the internet as its data source, and I think we all know that the internet is a great tool, but sometimes it's not necessarily giving you accurate information. So, any thoughts on how that kind of plays out?
Well, I think it will play out over time. I think that clearly explainability is difficult. You've got a lot of self-advised learning that has to happen.
Mhm.
You've got training costs that remain high. They continue to remain high. You've got inference costs, which are the costs of energy, and the computing costs are exceptionally high. It costs ChatGPT on average roughly 50 cents to a dollar to do a query. Google do it for 1/100th of a penny. So these are all things that I think have people worried or apprehensive, if anything. But like every technology, you're going to see an exponential decline in costs going forward. And this is all a result of our computing capability, which has obviously exploded. I mean, virtually every 18 months, our computing power is doubling and the cost of computing is plummeting. So this is creating an array of use cases that years ago was just science fiction. And
Mhm.
ChatGPT is a further illustration of this. And I think the bounds are so wide here that it's got people just confused because they don't quite know what to make of it. But when the iPhone first launched 12 years ago, there was no such thing as apps.
Right.
And within 10 years, I think the app industry had grown to over $100 billion, revenues. I'm not even sure what it's now. It's probably, a magnitude of that. And so this all happens in a pretty fast period of time, and especially when you can get the ubiquity of these technologies disseminated like we can now. I think anything can happen. I mean, again, ChatGPT got to 100 million users, inside of 2 months.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.